Well, good afternoon. My name's Cynthia Runge, and I'm a family law attorney in Boston. I'm the owner of Peridot Family Law. We're a full-service family law firm. We focus on mediation, collaborative law, and litigation. I'm here today to introduce you. It's my pleasure to introduce you to John Marroni, who is a divorce, financial, mortgage professional. And I had the pleasure of meeting John at the Mass Council for Family Mediation, where they had a panel of real estate experts, appraisers. He was there to speak about mortgages, and he was really, really helpful. And I asked if he would join us today for our Zoom. I just want to remind folks that we are recording today's webinar, and there's going to be a Q&A at the end. So if you don't want your voice recorded and you have a question, you can put a question in the chat and I'll read it, and then John can answer. And if you don't want your name to be visible, then you can please just, rename yourself to an anonymous name. Eventually, we will put this on our my YouTube channel, because it's I love to have resources for folks when they're going through this challenging process. So without further ado, I'm gonna let John introduce himself while I pull up the PowerPoint.
Awesome. Thank you for having me, Cindy.
Thank you for being here.
All right. Yeah, so my name is John Marroni. I am a certified divorce lending professional. And just a quick background as to how I got to this point. So I've been doing mortgages for, oh my Lord, coming up on 29 years. But before that, I was actually an engineer for 8 years. And when I left engineering to get into mortgages, the mortgage industry, I was so amazed how they took something so simple, lending money, and they complicated the heck out of it. And I was like, guys, this is not rocket science. I know what it looks like, and this is not it. It's people just want to borrow the money. They want to close on time, and get the best deal possible. So I've always tried to simplify the process. And I've actually coined this phrase, acronym ICE: income, credit, equity. If I know those three things, I know exactly what I can do for you. So over the years, I've always tried to simplify it, but I've also noticed when it came to divorcing couples or spouses, one of them that wants to keep the house or what have you, by the time they get to me, the settlement agreement's already written up, and if there was, I was looking at it saying, if there was language in the settlement agreement done a different way, the result of the the mortgage finance, it would have been a lot easier. So I would basically I help divorcing attorneys and their clients with their home equity solutions. That's it in a nutshell, and we'll talk about that further.
Great. All right. So I'm going to go to the first slide.
Mm-hmm.
And can you tell us about the pieces of the puzzle?
Yes. So there's four pieces. There's the family law piece, which deals with all the legalities, the settlement agreement. There's the financial and tax planning, gets into tax implications. If someone were to sell the house, capital gains, things of that nature. On the left-hand side is the realtor as well, gets involved, and mortgage planning is where I come in. Next slide.
Okay.
Okay. So on this one here, as you can see, let me just get out of this real quick. So as you can see on this, you can see how all four areas intertwine with each other. So, and it's all around the home. So when the home is on the marital balance sheet, this is what it can really look like. You can see just how intersected these four pieces of the puzzle really are. And this is an example, it only takes into consideration a small fraction of possible overlaps, and the need for a very knowledgeable and strong professional divorce team is critical. I mean, it's really not as simple as, one spouse retaining the house or just simply selling it. There's a lot more involved in the overall picture, and the areas overlap, affect not only the divorcing couple, but it can impact how each member of the professional divorce team effectively does their job. Whether it's the attorney, financial planner, or the divorce planner. And for all of us professionals that are involved to provide a higher level of service to the divorcing client, it's imperative that we really acknowledge how the home can impact multiple facets of not only the divorce itself, but life after divorce. I mean, there is life after divorce, and we always try to set our, divorcing couples in the best light. So, and again, a lot of, the settlement agreement, you'll probably hear me say this over and over, the settlement agreement outlines the division of the marital assets, any assignment of debt, et cetera. However, from a mortgage planning and execution perspective, the verbiage in the settlement agreement has to be very clear and not conflict with the mortgage guidelines, which unfortunately is often, the case, making it harder to obtain mortgage financing post-divorce for both spouses, because, what may be a legal solution, may not be a mortgage solution. Next slide. And no questions yet in the chat. Because they can ask questions as they go along.
Okay. I have a question, actually.
You do?
Yeah, I do. Yeah. So at what point do you generally become involved when, people are thinking about divorce and they're trying to figure out what to do about the house?
I would say at the very beginning, you want to definitely get me involved. In fact, I believe, let's go to the next slide. It's a perfect segue. There it is. The journey of a divorcing homeowner, right? So this is, you can see at the top where it says divorce mortgage planning. I believe that line should be way over to the left when it comes to self-reflection, because, they're reflecting on, I mean, this part here, they already know they're going to get divorced. All right. So now they're reflecting, okay, what are we going to do? We want to keep the house? How do we keep the house? Should we sell it? Should we buy it? Well, our children, they might be they just entered high school and we want them to finish up in the same house, in the same neighborhood. And what can we afford? Like, let's say one spouse wants to retain the house. Is that possible? So then what happens is, that's when you want them to get with me, because I can come up with different options and scenarios, because you might get into a situation where the husband will say, let's say the husband's moving out and wants to cut ties completely, but he wants an equity buyout, wants some cash. So is it possible? How do we go about making that happen for the husband to get off the mortgage, sign off on the deed, and walk away with money? Is that possible for the wife to even qualify? And if she doesn't qualify, what does that mean? What kind of options do we have? And then we go on to the next phase is, all right, we're going to do it. Maybe verbiage in the settlement agreement becomes very imperative. Let's say the husband says, all right, you know what? We have a low interest rate now. I'm good for about a year. So let's do nothing, but I want to buy something else. And I'm afraid the mortgage is in my name, so I'm not going to be able to qualify. So this is where the language on the settlement agreement is critical, where you put in the language that the wife is responsible for, anything to do with the house, the mortgage, real estate taxes, homeowners insurance. So once it's on the settlement agreement, and it's all signed off by the judge, from day one, I do not have to debt the husband for the mortgage, even though it will still show up on the credit report. Had it not been in the settlement agreement, the only other way around that would have to show that the wife was making the mortgage payment for 12 months out of her account only. And that's critical too, because if they just happen to still write checks from a joint account, that doesn't count, because now he's still showing that he's making the payment. So my advice would be for the spouse to open up a separate checking account, and then in that case showing 12 months payment, and then I don't have to debt the husband for the mortgage. Yeah. On a side note, even if it's not a divorce situation, there's a nice little tip here for you. Let's say you co-sign for your children's auto loan or even student loans. My tip to you for today is when it comes time to repayment, have the payments, have your child open up a checking account in their own name. So as long as the child's actually on the note as well, and they make payments for 12 months out of that account, after 12 months, when it comes to a mortgage, I don't have to debt you for that trade line at all, which is huge because during the refi market, there were some people I couldn't get qualified because they had co-signed for student loans. The payments were astronomical. Had the payments come out of the child's own account, I would not have to debt them for it. So that's just a little side note on that when it comes to debt.
John, I have a quick question related to that. So
Yeah.
sometimes, you might have an agreement where someone's going to be paying child support to the person who's in the home.
Yep.
And maybe they have an agreement where, the spouse that's staying on the mortgage is collecting all the mortgage interest, until they're off the mortgage, and maybe they want to pay it, out of their account. What are your thoughts around that? How to craft the language to give the the person who's receiving child support credit during that 12 months when he or she needs to show that they have made payments?
If it probably depends on the end goal. Like it's like it's one is if someone's gonna not want to be debted for it, you kind of structure it that way. So they just want to if they're both on the mortgage, if one claims interest and the other doesn't,
Mhm.
I'm not a CPA, but I know some might say, well, whoever actually wrote the check gets the write-off.
Mhm.
It's kind of a gray area. So I'm going to defer back to the legalities of that.
Okay.
You
I
know,
guess I was thinking more in terms of like if the recipient spouse has to eventually buy out the payor.
right.
What are some things that the recipient spouse can do to make sure that the mortgage, that they're showing income sooner rather than later? I think you mentioned like having a separate account.
So you mean she's showing income from money that she's receiving from the husband?
Yes, or in that particular scenario,
So
sure.
he's going to write her a check directly
Mm-hmm.
for the support, opposed to having him write. Here's the other thing too, on a side note. So this is where some people get tripped up too. Let's say the support payments are $2,000 a month and the mortgage payments are $2,000 a month. The husband might say, you know what, I'll just pay the mortgage, in lieu of paying you child support. That's like the worst thing, especially for everybody, because now the wife doesn't get credit for receiving the child support because she's not getting the child support, and the husband will be debted on the mortgage because he's the one making the mortgage payment on something like that. I would just say, not to get caught up on the, who gets the write-off on the interest. Just you got to just keep it clean. If he's going to pay child support, pay her directly. Period. Because sometimes people can be funny and they could say, hey, he hasn't been paying me child support, and then he's like, well, I've been paying the mortgage, and the judge is going to say, did you pay her child support? No, I didn't. That's a yes or no question. All right. And then the conversation, I'm sure, will shift in a different direction real fast. Might even say you're in contempt. You got to keep it clean. If it's child support, pay the child support, and not get caught up on trying to get a tax write-off until you can. That's what I would do. But after we get off this, I'll do some research on that to see. There are some workarounds, but that's a great question.
Oh, look, it looks like there's a couple questions here. So one question is, just to clarify, if it's in the family's best interest to keep both names on the mortgage and spouse two wants to continue living in the house, spouse one can free up debt obligation after spouse two pays entire mortgage out of their own non-joint account for 12 months?
That's if it, the short answer is yes. However, you could speed that up by putting on the settlement agreement that who's ever retained in the house is responsible for the mortgage payment. So then from day one, the husband that had moved out would not be, in my world, when I go to calculate what he can qualify for a mortgage, that mortgage payment that he's on that shows up in the credit report, I don't have to include that for debt ratio purposes. He's still obligated in terms of the legals. If the mortgage payment is late, that's the only risk that he would take, is if the mortgage payment was not paid on time, because that will affect his credit.
Right. And just, it obviously it could be a she or a he, depending on
Yeah.
the case.
Just,
Right.
of course, yeah.
Okay.
Uh,
There's another question too. Is there any other way to prove wife's ability to pay mortgage other than paying it out of her account? For example, regular transfers to the husband's account to cover mortgage expenses. Currently, we are separated but retain joint accounts to enable money transfers within one bank. I transfer money bi-weekly to cover mortgages and other real estate expenses. Would that be enough to prove my ability to pay home equity loan?
no, they're going to talk. They're just going to look at an income standpoint. They're not going to look at what you're outlaying. Although, there are bank statement programs where they'll look at deposits and evaluate the deposits, but they won't evaluate the withdrawals from it. And I would just say at that point, just get separate accounts is what I would do. Because if it's a joint account, right, one can argue that it's the other spouse's money. But if you have separate accounts in your name only, then it's clearly yours.
Okay. All right, so we're gonna go on to, if you want to go through the rest of this slide, John.
Yeah. So you know what we'll do? Let's go to let's go to the next slide, because it's a little more clear. Here we go. This is when it comes to the mortgage itself. So the phase one of the mortgage. So now we've decided, okay, we're going to try to move forward and do something. So the very first step is, we vet the house first. The obvious thing is who owns the house. Make sure, maybe sometimes it might be a second marriage, and one spouse had already owned a house with their previous spouse, and they never did anything about that. So that's one thing you want to know right off the bat, because if someone else has ownership to the house, that person's going to have to get notified and be able to move forward accordingly. Also part of, so that's, how title is held, and then the valuation, you can value it two different ways. When you try to come up with an agreement, you can have a realtor take a look at it. I know some people will go online and they'll get on Zillow or what have you. We use an appraisal. We have an appraiser go to the house. That's the value that how we determine is an actual an appraiser. And then of course, what's the current mortgage balance? What are the taxes and insurance on the property? And then the next phase is like the qualifying income. Again, whichever spouse is receiving support, we need to demonstrate that they're going to, that they have received it for 6 months, and that it's going to continue for at least 36 months, after the close date. So that's, the child support, alimony, lump sum can be tricky. Fannie Mae tightened up on this a little, where if we did a lump sum and we put it in a revocable trust, And if they just received 1 month's distribution, just get a letter from, and we could demonstrate that whatever that distribution was, that it would continue for at least 3 years. I could use that income. So they kind of tightened up on that, saying they could do that, but as long as that money that's in the revocable trust came from the actual spouse that's who is the beneficiary of that trust. So it can't come from like spouse one to spouse two. The only other way around it is perhaps if the spouse was going to give, spouse one was going to give spouse two a lump sum. One way that would work right out of the gate would be maybe open up an annuity that pays out, payout certainty for at least 3 years. We can use income. So you could have someone that's not even working, and that's how we can create income. Putting money into, say, an annuity, and as long as they can demonstrate that whatever the distributions are, let's say it's $9,000 a month, and that it's going to continue for at least 36 months after closing, I can use $9,000 a month for qualifying income, even though the spouse may not be working.
Looks like there's a couple questions here.
Sure.
Okay. One question is, how do you determine the equity of one spouse versus the other?
You mean in terms of the house itself?
I'm not sure. The question is,
Okay.
how do you determine the equity of one spouse versus the other? So as I understand it, maybe John has a different thought. Yeah, she says the house itself, but
Okay.
the equity would be the fair market value of the home, as you agree, or as as determined by an appraisal, less any mortgage and or HELOC, and that would be the net equity.
Well, I'd throw one more thing in.
Yep.
That if you were going to sell the house, you'd have to pay a real estate broker probably 5%. So I'd put that in there as well.
And attorney's fees, closing costs.
Yeah. Just
selling
pretend
it.
like you're going to sell it, and then that's how you determine the equity and divide it by 2.
Okay.
Something like that.
Couple more questions, and we'll just see
Sure.
how far we can get. If one spouse put down 20% for the purchase of the house, would that increase their equity?
No.
I'm gonna answer that one. I'm gonna say that would be something that the lawyers would probably have discussions about.
Yeah.
Most likely, and particularly like how long the marriage was and what the understandings were and things of that nature. And I think
Right.
the rest of the questions are the same. Okay. I'm sorry, Jen. So do you want to continue?
Sure. So, okay, consumer debt analysis. Again, we touched upon, the husband, wants off the mortgage. I keep saying the husband. I'm sorry. I'm just, yeah. Spouse one wants off the mortgage. Spouse two wants to keep it. Again, it's important to put the language in there. Probably for all debt, actually. It's if one spouse says, all right, I'm going to be responsible for all the debt, just put that in there. Because you want to set them up nice for, divorce. And again, I'm going to stress that the pay directly, whoever has to pay the support, pay directly to that spouse, opposed to, in lieu of paying off bills or what have you. It's just, you just got to keep it clean when it comes to making the payments. Because that way everybody's covered, legally. And then, then we got, the home equity solutions, it's again, having them make an informed decision. I had a situation where right off the bat, they wanted to sell everything. They happened to have a second home, vacation home in Plymouth, Massachusetts. Husband, in this case, it was real. So the husband was moving out, and he worked in Boston. And I said, look, if you sell that vacation home now, you're going to be paying all kinds of capital gain taxes on that. I go, why don't you live there for a couple of years and commute to Boston, make it your primary residence, and then sell it? Because now you have your primary residence. You're single, but you get that first $250,000 exclusion of not having to pay a capital gain tax. So that was like a perfect example of someone speaking with me before they did all this agreement, and they were able to save lots of money in capital gains tax, just something simple like that. So on that one. the one of the I'll talk about this one later. Let's go to the next slide.
Actually, can I ask you a quick question about the HELOCs?
Yes.
Okay. So, and actually another follow-up question. So for the HELOCs, sometimes in the middle of litigation, you know, a spouse might need to access like funds and look for an advance. Sometimes the house is only like the only asset. Can you speak a little bit about how you might be able to help folks in that situation, or and what they should be like thinking about?
So you mean someone wants to do a buyout on the house?
No, sometimes you can get an order from the court, like, you know, you're
Yeah.
seeking an advance on fees, and a court might say, okay, you can go get a HELOC, so you can get an advance on what you're entitled to as part of the marital share.
Right.
Right.
Yeah, no,
So,
they can absolutely get a home equity line of credit. You just go, and as long as you qualify for it, absolutely, and you can use that
mhm,
line of credit. It really comes down to whether they can qualify
right.
for getting the home equity line of credit. And absolutely, yeah, absolutely.
And what are
Um,
the pros and cons of doing that? You know, what are your thoughts around that?
well, I mean, it depends on how long they're going to keep it. Right now, the home equity line of credit rates are pretty high. They're probably like 8.5% and 9%. But at
Mhm.
the same time, at least you can get it set up. Picture a home equity line of credit is just like a credit card. Whereas if you don't draw against it, you're not paying any, there's no required payments. Or you get whatever you draw, you're only required to pay interest only for the first 10 years on it. So that definitely helps. And it helps, if in terms of a buyout, maybe someone might not want to refinance the first mortgage. So something like that would definitely help. The only thing is, if if someone wants off the mortgage and the deed, the only way to get off the mortgage most of the time is to refinance. There are loans that what they call assumable. Typically, those are FHA mortgages or VA, and so because it's assumable doesn't mean it can happen automatically. So if spouse one wants to retain the house, spouse two wants off the mortgage, and if the mortgage is assumable, spouse one needs to at least be able to qualify to carry the mortgage by themselves. But most of the time, most loans that I'm coming across are not assumable.
Okay. Can you
So,
explain a little bit more about what it means to be assumable? What would be the effect if somebody's able to assume the mortgage?
so what that would mean is they would be the only person on the mortgage, and the other spouse is now removed from the obligation. So it will no longer show up on the credit report
How would
at
their
that
rate
point.
be affected in that
It
case?
wouldn't. It'd be the same exact rate.
So that's a huge benefit if you can find a way to
It
do it.
is. That's right. Absolutely. And then at that point, then the spouse that got off the mortgage can also, get off the deed as well.
And before we switch slides, can you also just say something about reverse mortgages and how those
Yeah.
could be used? Okay, thank you.
So reverse mortgages, you have to be at least 62 years old. In fact, they're calling it the gray divorce. That divorce rate, the divorce rate of folks 62 and over have tripled since the 90s. And what's happening is it's tougher for folks to get divorced financially. They can't recoup, or they may not be in a position to be able to qualify for a new mortgage. So a reverse mortgage, you could refinance the mortgage with a reverse mortgage. So a reverse mortgage, to keep it simple, picture getting a regular mortgage, but you don't have to make payments. So if you didn't make payments, the interest on the mortgage would just accrue. And as long as you're living in the house as your primary residence is defined as 6 months and 1 day. As long as you are there, you never have to make a mortgage payment. You still have to make your real estate tax payments and homeowners insurance, but you don't have to make the mortgage payment. And that could be a lifestyle change for most people. If their mortgage payment was 1,500 or 2,000 a month or even more. All of a sudden, the mortgage is still there, the payment is still required, but it becomes like a negative amortization, and then it gets paid off when you move out or pass away, and the heirs have a choice. They could actually refinance that reverse mortgage if they want to keep the house, or simply sell the house. Most reverse mortgages, they're like an FHA product. They're non-recourse, which means if the value of the house drops below what's owed on the mortgage, no one has to come up with that difference. So if the mortgage balance is 600,000 and the house is 500, you're only required to pay the bank back 500,000 on the reverse mortgage.
This,
Which is,
oh, I'm sorry. Go ahead.
no, that's a nice feature.
Yeah. Can you speak to, there's a question about what is the period of time for a HELOC?
So the interest only portion is 10 years. And then after 10 years, they fully amortize it. So HELOCs will typically go anywhere from like 20 to 30 years. It depends on the term and the bank. But I usually see like 20 years, so maybe, or even 25 years. So if you just did interest only, and then at the end of 10 years, if it was a 25-year, then you have to pay it off, and it gets amortized over 15 years. Or you could always refinance a HELOC with a HELOC and start all over again with the interest only portion as well. So.
All right. We're going to go to the next slide.
Yes.
All right.
So many questions. Again, can I keep the house? Can I buy the house when I'm still, joint on a mortgage? We talked about that. Yes, you can. And that, depends on how that we put that language in the settlement agreement. Can I forward a mortgage alone? We could talk about that. What are the legal obligations of joint mortgage holders? Well, the legal obligation is you're obligated. In terms of the mortgage world, if it's set up properly, we may not have to debt you for that mortgage. The most common question I've been getting today is, we want to keep the house. Spouse wants to keep the house. We have a great mortgage rate, and we don't want to get a higher rate. What are my options? Okay, well, the first option is see if the mortgage itself is assumable. We talked about that briefly. And if you do that, you just, and the spouse that wants to keep the house, retain the house, can qualify, then yes, exercise the assumption clause. Another option would be, okay, spouse one just stays on the mortgage until spouse two sells. That's an option. Or they might want to put a timeline that spouse two needs to refinance in maybe 2 or 3 years. There is some risk with that, because 2 or 3 years that spouse might be in a situation where now they don't qualify for a mortgage. So, and so those are the things that they need to wait. I mean, it could be that, let's say spouse one it's very important for that spouse to be off the mortgage. And now maybe the mortgage is going to be $700 more a month with the current mortgage rate. So maybe they might just work something out, knowing that the spouse maybe is going to sell the house in 3 years. So we say, okay, so 700 a month, right? So it's like, 8,000 a year, 25,000 over 3 years. Maybe spouse one might just do a couple things. Say, listen, I'll give you an extra 25,000 as part of the settlement if you refinance. Or it might be a situation where there's an auto loan that's, say, $700 a month, and that spouse that wants off the mortgage may agree to take over those payments on the automobile to offset that extra payment. So it's all about trying to figure out different ways to make it work, with the higher rate. And it's or there may be a situation where the husband's going to spouse one, is going to walk away with, say, $200,000 and just wants to cut ties. And again, the same scenario, knowing that spouse two is going to sell the house in 3 years, I would suggest to spouse one, if you want your money today, instead of taking 200, maybe take 170 and give her the 30 to offset the extra mortgage payment. So it's a matter of, or agree to pay the auto loan. There may be a situation where I actually had a situation where the husband was going to take 200,000 and everything, they were agreement, but guess what? She didn't qualify for the mortgage. But then I was looking at it, there was an auto loan, it was like $600 a month, it was like a $25,000 balance. And I said, all right, to the husband, I go, why don't you pay this? We'll make, in the settlement agreement, I said the husband's responsible for the car payment, and we're going to refinance. And 30 days after the refinance, the husband's responsible for paying off the car loan completely. So by putting it in the settlement agreement that the husband was responsible for the car payment, I didn't have to debt the wife for the car payment. She was able to qualify for the equity buyout refinance. So it's a matter of just getting creative and strategizing the best way to do this, because sometimes you're probably listening to what I'm saying and people saying this doesn't make financial sense. It probably doesn't. What it really does is it helps people move on, because when someone says they don't want to refinance because of a higher rate, what they're really saying is, I'm concerned about my cash flow options, my cash flow every month. What can we do to help solve this? And, because, sad, divorce is tragic and sad, but, it comes with a price too. And this is part of it too. So, and the idea is trying to set up the divorcing couple, in the best light possible. Again, there is life after divorce, and we want to try to set them up, at least financially anyways, best light possible. We haven't even gotten into the children part. That's a story for another day.
Right.
You
Couple questions for you, John, if I can.
Yeah.
I don't think you addressed this specific question, but can I
Sure.
use voluntary support payments to qualify for a mortgage?
No, that's a great question. I get that a lot. It needs to be in writing, and it needs to be either a temporary order or in the settlement agreement. It can't be voluntary. It needs to be agreed upon, and it has to be stable and consistent. You can't be 2,000 1 month, skip a month, and then another 2,000. That doesn't work. It has to be 6 months continuing to be able to use it to qualify. That's a great question.
And you addressed part of this, but I'm going to ask it this way too. Can I buy a house when I'm still joint on, the mortgage for the marital home?
I'll say yes. The attorney will say no.
Okay, why?
Yes, be careful, because what happens is until it's settled, because you buy something, now all of a sudden now you have an asset that you have to disclose that you have.
Mm-hmm.
And maybe the spouse is okay with it. The judge may not be.
Mm-hmm.
So
what about from a financing point? Are there problems with already being on a mortgage or being debted for the mortgage?
no,
And if a person wants to go get their own mortgage in their own name?
that's fine. In my world, that's fine, as long as they qualify.
Okay. All right. And I think we have one more slide here. All right. Do you see that?
That's what happens when it's successful. Everything comes together quite nice.
All right.
So what makes a divorce successful? I guess we define success. The very first question I ask people is, what would the ideal outcome look for you?
Mm-hmm.
And then we try to back into that. It's really what it comes down to. kind of have a vision as to what your life, what you want it to be like after divorce, as best as it can.
Do you work together with a team? Like when you're helping someone that's going through a divorce, how do you coordinate with professionals?
I'll get on the phone with them, because sometimes, you know, sometimes they just kind of relay the information back and forth. If it's a little complex, I'll just, speak to the family law attorney, or it could even be the financial planner as they're trying to put things together. And yeah, I think it's best when everyone's communicating, because then it comes together nice. Because again, we all are looking at things with our own perspective. Family law attorney is going to look at it one way. I'll look at it another. The financial planner will look at things differently in terms of capital gains tax planning standpoint, things of that nature. But so when everyone is talking together, someone might say something to me that I didn't even think of. Say, oh yeah, let's try it that way. So it's better when all eyes are on it. Absolutely. Yes.
Great. All right. Well, so John, if people have questions and, is it okay if they reach out to you directly?
Absolutely. Yep.
Is
That's
that
my,
the best way?
that's the, yes, absolutely. Yeah. You can call me directly on my cell phone, or you could Google me. I'll come up if you Google me. Or the email as well, John Marroni at divorcelendingstrategies.com.
Great. All right. Well, I see that we're coming up on the hour, and I just wanted to thank everyone for coming to our program about mortgages. And I know it's something that those of us who work in the divorce sphere, it's always a concern for our clients. So, and with that, the dogs are here. So, I want to thank everyone, and thank you, John.
All
And
right.
this will be on my YouTube channel probably in a week or two. So thank you everyone for attending.
Thank you, Cindy.
Take care.
Awesome. All
Bye-bye.
right. We'll see you. Okay.